It's the weekend rip.
Ooh, and we're live, folks. We are back. It is, I was going to call it the other name. It is the weekend rip with Ben and Emil. My name is Ben. That's Emil.
Coming to you on a Thursday.
On a Thursday, Juneteenth. Huge shout out to everybody celebrating Juneteenth, except for Charlie Kirk, who apparently told all of his employees that they're going to still work today despite the Fed holiday. And the markets are closed, so we're kicking back. We're enjoying ourselves. If you're new here, we are the best show.
Just the best show.
We're the best show, period, but also the best on FinTwit. We taught everybody what they know, including Jim Cramer and our guest here today, Cem Karsan. Not to brag or anything, because as everybody knows, I'm the best trader out there. I'm worth billions of dollars, and I just do this out of the goodness of my heart. And without further ado, we've got Jim himself. He's got his Make Volatility Great Again hat. Thank you so much for joining us, Jim.
Happy Juneteenth. Good to be here, guys. Long weekend. We get to kick this off, the jam session, with right on June Opex, big quarterly Opex on Juneteenth before a long weekend. Let's bring it.
Man. All right. We got a lot coming, so stay tuned. We're going to first talk about the Fed decision this week. We've got stagflation. We're talking about the rise of populism, and most importantly, what everybody's tuning in for, of course, is the crystal ball.
We're going to be doing the crystal ball with Jam. Don't worry.
Yeah, he's going to tell us exactly what's going to happen.
Just stay
crystal
tuned.
Ball music.
Yeah. So let's do the Fed decision. We had the Fed leaving rates unchanged for the fourth straight meeting. They say that uncertainty has diminished, but it is still elevated. They lowered the GDP estimate to 1.4%, lifted the inflation estimate to 3%. The median Fed forecast shows 50 basis points of rate cuts in 25. Shows rates at 3.6 in 26, 3.4 in 27. Interest rate futures are increasing the likelihood of rate cuts beginning in September. And the Fed is standing defiant in front of Trump, even as he is calling for a 100 basis point rate cut. And curious what you think about this. Are they making the right decision?
I think the Fed said the word inflation something like, Powell said it something like 20 times, which is the big sticking point at the end of the day, which was responded by Trump with the word stupid or idiot, I think 9 times.
Yeah.
So not a smart person, I think he said a couple times too. I don't know if, the reality is that at the core of everything we're going to talk about today on the macro side, we'll talk about flows separately, is this 10-year bond question. And at the core sits liquidity in the Fed and this head-to-head battle between Donald Trump and the administration and the desire to wrest away the most powerful tool in the way, which is monetary policy.
Yeah, I really like you tweeted out Donald Trump's statement, which is, as one can imagine, is just
Speaks for itself. I didn't have to put a comment in there. I just post
I love
the
what
comment.
he said. He said, "I don't even think that he's that political." Referencing J. Powell.
Yep.
I think he hates me, but that's okay. He should. I call him every name in the book, trying to get him to do something. I've been nice to him. I do it always. I know how to sell. I've been so nice to him. Fellas, you wouldn't believe. Let's have dinner. Too late. I'd call him too late. Come on, too late. Let's have dinner. I do it every way in the book. I'm nasty. I'm nice. Yeah. He's just like a
volatility
stupid person.
great again. That was the most volatile commentary I've ever heard in my life. No matter what you think of him, he's volatile.
Yeah, he thinks that. I don't know what to think of whenever Trump says stupid garbage like this, but he's now saying, "Hey, maybe I should be in charge of the Fed. Maybe I should be the one calling the shots."
Yeah, do you think he should appoint himself? He said maybe he'll appoint himself. I think maybe he's looking into the legality of that.
Well, the reality is that Richard Nixon appointed Arthur Burns, who was his long friend. The conversation turning to Bessent potentially being the Fed chair makes a ton of sense. It is, quote unquote, an independent entity. So once they are appointed, Trump loses control of that other entity. And so he wants more than anything. The reason him saying psychologically, like, maybe I should point myself, is he knows he needs to find the person he can most trust, and he doesn't feel like he can really trust anybody in this situation, to do this most important thing, which is control the Federal Reserve. So when he says that, what he's saying is, I got to find, who do I choose? Because I lose control the second I appoint somebody. It's got to be somebody who's going to do my bidding.
Who do you think he's going to, for the next year when Powell's time is up, who do you think he's going to go for? Weren't there rumblings that it was going to be Scott Bessent?
Yeah, I think it is.
That's what Jim just said.
Yeah. And that's why, because it's the one person he's gotten comfortable enough with that he feels like he can trust. I mean, I would shock me if like his, if it's one of his sons or like somebody like. My point is that he wants to find somebody that he can know absolutely when push comes to shove that they are going to do his bidding.
And Eric Trump, head of the Fed, is a fun image for me.
Exactly. That we should play around with that. That could be one of the memes here that comes out of this. But the reality is, he is if he wasn't subject to the bond market freaking out, right, to him choosing somebody who doesn't make any sense, he would gladly choose whoever he feels he can control in that situation. It makes sense politically. This is not a political comment. Like, the reality is, it's the most powerful position in the world. It's more powerful, I'd argue, than the president of the United States. Mm-hmm. And he wants that lever of power.
Could you explain a little bit why he wants that lever of power, like, and what he wants to do with it? If he gets his way and he gets Scott Bessent or Eric Trump or whoever he gets in there, what does he want them to do?
Yeah, that's a great question. So let's be very explicit. Monetary policy drives liquidity from the Federal Reserve, drives liquidity for the world, period. Full stop. It is by far the biggest, most important source of liquidity in the world. And liquidity drives assets, point blank. Supply and demand is what drives the bond market, the stock market, the commodities. Every market in the world is driven by supply and demand. So the supply of money, of the reserve currency of the world, is the most important position on the planet. Trump can try and tangentially control those things. He can control geopolitical outcomes and war and other things along those lines. But if you want to control markets, can't do it. Only the Federal Reserve can do that.
And in a nutshell, to the layman who might be in our audience right now or might be watching, that liquidity is just basically the higher rates are, the less liquidity there is, the less money there is in the system, the less likely stocks are to go up, assets are to go up, whereas he wants rates to go down so that there's a lot more liquidity, there's a lot more lending, a lot more free flow of capital. Do I have that right?
Yeah, I would say you were 100% right until the word quantitative easing or quantitative tightening came into the world. Nowadays, they can explicitly buy bonds and buy all kinds of bonds, by the way, not just U.S. government bonds, right? We saw that during the housing crisis. They are essentially printing money. If you buy the bond that your government is selling, and you can do that at unlimited scale, one side is borrowing and one side is creating the money, and so you're just printing money and making it go around. So they don't like using those words. They call it quantitative easing because that sounds a lot less a lot more responsible than money printing. Yeah. But the Federal Reserve controls the power to print and create money supply. And at the end of the day, if you can print as much money as you want of the reserve currency of the world, it's kind of a big deal.
My eyes always glaze over. Every few months or so, I refresh my education on this stuff, and I begin to understand it all over again. Like, okay, yeah, that makes sense. But then when I hear it and I see it all over FinTwit, I'm just like, oh shit. And for that matter, it is very interesting to me how the bond market and interest rates and stuff seem to be just like in the headlines daily, and now it's just not. Now it was like bonds, trade war, back to bonds, and now obviously what's going on in Iran. And it's just so funny how the market can be so finicky about something for just a few days, and then it's just like, yeah, who cares anymore? Well, on to the next thing,
Yeah, which I think is I mean, again, the biggest story is the long-term bond. And we can get into why that is it's the denominator. Like if you take any finance class, your 101 class is what is the discount rate? And for most people that goes in one year and then goes out the other day, and then they start, thinking about all these other bright, shiny objects. But the reason the discount rate or the 10-year bond, the risk-free rate, is so important is it's the denominator. It is the thing that determines the value of everything because it's what everything is relative to. And I can I can put that in more kind of simple terms if you'd like. 1968, the 10-year bond is 4%. What is the earnings yield of the S&P 500? The inverse of the price-to-earnings ratio, 4.4. In 1982, the 10-year bond is 20%. What is the earnings yield of the S&P 500? 22%, 4.5 PE. Because those two things have to be integrally connected. If you can get a 10-year bond for 20% risk-free from the U.S. government, guess what? You're not going to invest in the S&P 500 for anything less than 20%. Pretty simple idea, right?
That makes sense.
Yeah. And so the 10-year bond is the divisor. It's the thing that everything, not just stocks, but real estate, anything that you're trying to make money on, the amount you need to make money on that you're competing against is that risk-free rate.
Why the 10 and not the 20 or the 5?
It's the long bond because at 10 you're essentially predicting whether a 10-year rate or a 20-year rate is different essentially becomes the same thing. So people refer to the 10-year. The reason the 30-year is a rarity. It's not a thing that it only really exists in the U.S. market. And they've done that because they can borrow for cheap.
Yeah.
And so they want as long duration as they want. But yeah, the 10-year is more actively traded. That's why I refer to the 10-year. The 30-year is less actively traded.
Gotcha. We opened, of course, for those who caught it, with George Costanza, a man we all know, love, and I closely identify with, touting his Summer of George, which you have tweeted about. I've been following you for years, and you've alluded to it many times before. And I believe you're still asserting that we're within the Summer of George right now. Can you just explain what the Summer of George is for people?
Yeah, there's a lot of nuance here, so
yeah.
buckle up. And I'm glad you're asking me to clarify because there's a lot of confusion around it. So summers, partially due to holidays like we're in right now, is the second most holiday period on the calendar other than November, which is Thanksgiving and Christmas, and then New Year's, and then President's Day. President's Day. The holidays here are Memorial Day, Juneteenth now, 4th of July. You have this very concentrated period, and it's the summer. Mm-hmm. So it's not just the days that are off, it is the days around those days, right? And people go to the Hamptons, people go to the beach, they go in Europe, it's a 3-month holiday, right? And that decreases volume, and that creates a situation where the structural flows, which don't diminish with this, are bigger relative to the liquidity and become more important. Mm-hmm. It's also a period where vol compression, if it starts to take hold, can overwhelm everything else. We have seen a period of vol compression into this rally that we've seen. So if you get a rally into the summer and vol's compressing, it's really hard to break that vol compression, basically. And when you have vol compression, we'll talk more about Vana and Charm and how it relates to this, but when you have vol compression, particularly in periods where there's big skew positioning, which there's record positioning now, and we'll unpack that at some point, that creates very positive equity index flows. And they're not every day, but they are particularly strong as we enter big expirations with big open interests, like the June Opex, which is this Friday. And so you have this loop where vol is compressed. Because of vol compression, as long as the market doesn't move, you have a buyback of stock that happens, which compresses downside even more and the risk of a tail even more. And then what happens is every day that goes forward, market makers and dealers in the street also decay longer vol. And they're already long vol. So they're long vol, getting longer vol, there's supportive flows coming out of it, and you just get into this loop. And remember, vol by definition has a risk premium and is a loser more times than it is a winner. So if you have structural effects like this, vol becomes a hot potato. No market maker, no dealer wants to hold any of the vol. And so it just goes lower and lower and lower and lower. And so this generally happens throughout the summer. And eventually, and this is not always, right? There's not every summer is going to be a summer of George. But once you enter into these periods where there's nothing going on, and just want to go to the beach and read a book from beginning to end in that order, as George says, you essentially it's reflexive, and it doesn't tend to come to an end until about August, and sometime between August and September, by Labor Day, it will turn. Usually at around August Opex is kind of the most likely, but again, the flows and timing of that can be a little different. Last year, it came early, which was in early August. There were signs that was starting to happen by July Opex, which, on the expiration of July, we highlighted that it was a time to buy vol and start placing your hedges early. Last year, after a earlier summer George, May, June, July. It started earlier. We were very open and avid about it. Go look at the chart for May, June, July. That is a classic last year summer of George. And we called for it is just massive vol compression, washing paint dry as the market takes higher. Now, not every summer of George. The key part of summer George is not market going higher. A lot of people think that's what it means. People assume, markets are placid, vol is compressed, that must mean we are going to go higher. Yes, it does lead to these von and charm flows and supportive flows. So in the absence of anything else, in a generally supportive, healthy market environment, yes, the market would just tick higher slowly, not fast. Very kind of grindy action.
A melt up.
But this is not every summer. So we have a summer of George, we have the vol compression, we have those supportive flows, but those are counteracting other flows, which are big macro headwinds. And we've been talking about those now for a while. We can get into those. That's a separate part of the conversation. But at its core, the flows piece is that kind of classic May, June, July of last year action. We've pointed to it other periods. And when it starts, it's months. It's a race to the bottom. And everybody's like, vol can't possibly be this low. Look at all the news. Yeah. It's like, how can this market be so resilient given that Israel just bombed Iran and that is the summer of George. That is these structural flows. Now, our view, and I'll get to this more and more detail in the crystal ball later, is that the macro will eventually overwhelm these flows. And there are stronger periods in the summer of George where the flows are more positive. And there are periods when those positive on-a-term flows are not as positive. But the fall compression, we believe, is structural and will last till August. So, again, just a teaser, fall compression, but not necessarily up. And we'll get to kind of more of those details later on.
A couple things. For the uninitiated with all of this talk of structural flows and vol compression,
I'm going to take the volatility great hat off because we're talking about vol compression here. So we're going to
take it off, baby. I feel like the best example of that is right before the COVID crash, where the market just kept ticking up, and everybody's going, "Well, what the fuck? We've got this pandemic, this global pandemic going on." But it didn't matter because at the time there were still those structural flows coming in and keeping the market afloat until I believe it was Jan or
February Opex. The day after Opex started, the COVID crash started the day after Feb Opex and ended the day after March Opex. To the
Unreal.
Day. By the way, nobody talked about that until I started talking about it, which is kind of a wild thing if you think about it. And I was there in front seat. I know exactly why. I can tell you the exact details of who was blowing out, why, what it was tied to, which options, expirations, and how it works. And that is a discrete example. And by the way, when did the most recent decline really kind of take hold, and we called this to the day, right? Again, the day after Feb Opex. And,
Yeah.
And that's, again, not a coincidence.
And also, just real fast with the summer of George, I believe what happens in that Seinfeld episode is George is so excited to have a great summer, but then he becomes bedridden or something.
He goes to the hospital because his legs atrophy and he can't. He can no longer walk.
He's stagnant. So
That's supposed to be in the summer of George.
Yeah, whenever it's the summer of George, and whenever you hear that, that's what it entails, which is that
Correct. It
all
always
of these,
ends badly.
And it's so hard to explain. Like, there are people in our audience who might not understand that when you say vol compression and things like that. And the best way, it's almost like there's no point in trying to really get into the nitty gritty of understanding it. All you really got to grasp and take away from it is that there's just not a lot going on enough to move the markets, right?
For now, and the implied vol gets lower and lower, and reflexively, this is an important note. Let me explain this a little more clearly. Is when that implied vol, what do I mean by implied vols? Like the actual options are sold to such a cheap level that the dealers who don't want it to be long or short vol or long the market short vol, but are get kind of saddled with this gamma, this the delta change exposure, because they're long volatility, they make money if the market moves. Mm-hmm. And so when the market moves down, they have stock to buy. If the market moves up, they have stock to sell. And if that vol gets so low, the interval at which they need to make becomes quite low in order to profit from this. So there is a structural bid and offer to the market that just pins the market. The best example of this is 2017. 2017, in 125 years of history. This is like, if you're a math or statistics person, you'll understand the importance of this more than others. In 125 years, realized volatility of the market was fairly stable. And there's high points and low points, but there's a very defined range. Okay. Same thing is true for correlation of underlying stocks in an index. Pretty stable range of how correlated or non-correlated they are. 2017 as a year had 30% lower realized volatility, 30%, than any other year in 125 years of history.
Why is that?
It also, by the way, I'm going to get to this, it also had, by 25%, the lowest correlation between the constituents of the index in history. So two dramatic outliers to 125 years, a big data set. And it's because there was so much vol selling, so much vol compression. There were iron condors in the indexes. People were selling a lot of vol for yield. There was XIV. Remember XIV?
Oh, yeah.
There were all kinds of vol selling, and it was such a sure thing because there's this loop. It was 2017 was the year of George. And there was so much compression that the market was pinned. I know this because I was one of the biggest market makers at the time. I was the one holding this. I was the one buying the stock and selling the stock as the market went higher. And guess what? Guess where we'd end up? The slowest part of that 2017 year, the slowest month was August, summer. And we pinned, there was a massive fund, a bunch of them selling all. We pinned to the strike for almost the whole month. You can go read about this if anybody's interested. A strike in the S&P 500 that was sold by a fund called the Catalyst Funds. Go take a look. It was, just to give you a sense, anybody who trades S&P, SPX, it was in the SPX equivalent, 100,000 by 300,000, one by three. So they sold 300,000 of a strike, 300,000 SPX size. That's 3 million, basically at the money options equivalents in spiders. It is a insane number. That's how much vol compression there was. And we literally didn't move off that strike all summer. Because the vol was so low. And so the point here is this has the ability to dominate the whole market, control the whole flows of the whole market, particularly if liquidity is that low. And the reason I mentioned the correlation part is this is part of how, other than me anecdotally knowing this, by being able to, like, seeing it, watching it, being the guy who was buying and selling it, we know this too because of that correlation piece. It is not a coincidence in 125 years to have two things that are almost equivalent outliers in history. Right? So we had a 30% lower vol for the reason I mentioned in the indexes, but it was in the indexes. It was in the S&P 500 that vol compression was happening. The single list stocks were not the place where the vol was compressed. And you still had idiosyncratic risk. What do I mean by idiosyncratic? You still had, like, if there's a new cancer drug, guess what? The cancer names are going to go up. If a CEO dies, guess what? The company, the stock will go down. Like, news cycles still would happen. We have a historical range to how single stocks would move and react relative to news. And the only difference between single stocks, who are generally moving at their historical range, right, and the index being pinned, right? By definition, the index is pinned and certain things are going one way. This is counterintuitive, but by arbitrage constraints, if the market's not going to move and certain stocks are going to go up, that means other stocks have to go down. Because together they equal the index.
Right.
Right. And so there's this other thing that happens during summer of Georgia, which is another nuance, which is very important, which is a thing called dispersion.
That's right.
And that's what this is. This is dispersion, right? And so what that means is the vol is very compressed at the index level. It doesn't mean all stocks are compressed in terms of their volatility. And so what we actually see during summers of Georgia increasingly is massive correlation breakdown. And what that ironically means is that things are moving more away from each other. So you see massive rotations in the market. And implied volatility of the single names actually can go up while the index is going down. Because the net move is not just, hey, if everything goes up together 1%, then okay, that's a certain volatility. But if the market's pinned, half the things have to go up 1% and the other things have to go down 1%, right? Or up 2% and down 2%. So there's this, it's like a magnet and a reverse of a magnet. It forces the constituents away from each other. So this is kind of, now we're getting a little more technical, but very important to understand these dynamics. And these are structural dynamics. These are not about some fundamental reality. They have to, by arbitrage constraints, if the index is pinned, force the single lists away from each other. Most people think that single stocks are the core, like an index they think is just a calculation of the combined single stocks calculated. What they don't realize is actually nowadays the index is actually more powerful in terms of its pressure exerted and traded more actively than the single stocks themselves even. And so that's actually driving more of the action, the indexes itself, than the single name. So it's really a push-pull between the two. And this is kind of a great example. So anyway, summer of Georgia is also a time of massive dispersion, as you highlighted 2017, and that's another big thing to think about.
The more you talk about this, the more it just feels like there's a select few at the top who've kind of figured out some sort of infinite money glitch, where they realize that they have so much power and so much influence via these the options mechanism at play with the vol compression and all that stuff, and they can just sell all these massive swaths of options, knowing full well that it's just so big that the market can't possibly budge in the face of it. And it's just, they collect a premium. They've figured out just week after week, month after month, quarter after quarter how to do this until you have those tail risk moments where it all can blow up in their faces. But I mean, can you speak to that when you hear about like JP Morgan's trading desk just having record profits?
It's not a conspiracy. I don't want to make it sound like that. What it is there are probabilities, if you understand something well, where you can make more money because you understand it better than others. Yeah. And you better believe, if you can, that people are going to do it. That's just business, right? That's free market. That's the free market. So, yes, understanding options and the importance of it. That's part of what we're trying to democratize here. Yeah. The reality is that most people still think about markets in two dimensions, like they're just stocks and it's a narrative, and you own a stock or you're short a stock. And the reality is that increasingly most positioning in markets, and this is, or a lot of it, maybe not most yet, and eventually we're heading in that direction, is not played in two dimensions. It's played in 3 to 4 dimensions. It's played with time and moments on a distribution, because options ultimately are just the underlying distribution for any asset. And so it's a much more flexible, much more accurate, much more dynamic way to position any knowledge that you have on any asset. And so why would you just go play in 2 dimensions when you can play in 3 or 4?
Yeah.
And so if you don't understand how these things work and how they interrelate, and that's what's actually happening under the hood, yes, you're playing checkers when everybody else is playing chess.
So basically, you're hoping that we can all learn how to be, those little fish that suck on the bottom side of like whale sharks?
Yeah.
You're teaching us how to suck on the underside of the shark, which is the big boys in the market. And I appreciate that. I've always wanted to be one of those little guys.
No, I'm trying to teach you how to be the shark. We'll get there. Okay. This is just the first lesson.
Before we get into the actual predictions, because we're going to be running short on time here, I am curious, in as much as these flows didn't really have as drastic and dramatic an effect on the markets up until like 20 years ago-ish, do you see it staying this way? Like, do you have any kind of prediction as to how these dynamics might change in the next 5 to 10 years?
Absolutely. And we've been talking about this for 10 years, and it's continued to go in this direction. This is actually, here's a great example. During COVID, everybody thought, all the option surge in volume was just some anomaly. I mean, universally, everybody was like, okay, this is just people YOLOing at home, bored, getting their tendies, right? That was the conversation. And I was very vocal 5 years ago that no, this has been a secular move. And much like a lot of other trends, like virtually, being on video and having virtual conversations working from home, this is an accelerant of a trend that already was in process. What is that trend? That trend is quite simply, there's a better technology. Think of it as a technology, a better way, dramatically better, way to position in markets. And it didn't come to fruition and dominate because there weren't enough network effects. There wasn't enough infrastructure. There wasn't enough volume. When I started in the business, I'm going to give you a sense, in 1998, we had paper tickets. There was no electronic marketplace. We only had quarterly options in the S&P 500.
Oh, those were the days.
They were traded at 25 strikes interval when we were trading 300-400 in the S&P. And we didn't even have single stocks. You could trade some over the counter, but largely there are very few options on stocks, much less anything else. Now we have daily, if not minute contracts. We have every strike. That's just in terms of product. We've gone from a 250 multiplier, which is where we were, to 100 to 50 to 10 to 1 to 0.1. We've gone to a massive volume increase. So an infrastructure, the tightness of markets is incredibly tighter. It's electronically traded. It is a much more sophisticated, liquid, available market. And that is what's called a tipping point. You hit a tipping point where all of a sudden the technology, which was always better, is now accessible, right? And adoptable. And that's where we are. And that's what COVID was. It was this hitting the tipping point and really taking off. And if you're asking me if we're going back, no. We're not going back from electricity to candlelight, right? We're not going back. History doesn't move backwards. It moves forwards.
Well, sure, but I guess I meant more so like I wonder what the next step of this evolution is.
I think the next step of the evolution is that options increasingly become, again, people refer to it as the tail wagging the dog. It is the dog. It is the three-dimensional dog. And the expected value of all those options that are being traded is the stock price. That's where we are. That's where we're heading. And the adoption of it, there will be, when they created electricity, it wasn't used by everyone because it was seen as dangerous, which it was dangerous. But guess what? People make it not dangerous and create a vehicle so they can just plug it into the wall and nobody even knows how it really works. They just use it, right? And options will become the same thing, and they are in the process of doing that. And that's why everything that I do and everything tied, the SIBO volumes at records, the interactive broker stock values at records, anything that's structured products are 3 times the volume it was 3 years ago. This is a gold rush. And we are still essentially in the second or third inning of what is a complete move to a better way of doing markets.
Since we're talking about next steps in the evolution here, should we get into some maybe crystal ball peering before we run out of time?
I've I don't know if you believe in the whole distribution days kind of thing, but I might have mentioned it one of the last times we spoke, but I've noticed that there's been a few distribution days going on the S&P wherein all you need for it is the volume to be higher than the previous day and for that same day to close down more than 0.25%. And that's just kind of one of my little things that I pay attention to. So yeah, on April 11th, you projected that a major market decline would begin in May or June. We had one of the strongest Mays ever, but then and by June, the index was within 3% of its all-time highs. I wonder what you're thinking with this big triple witching Opex and what's to come. What do you think, man? What's going on, Jim?
So before we unveil the total crystal ball here, I do want to address what you just said, which I think is very important.
Mm-hmm.
There are reliable things that have worked with some level of probability, like technical indicators, like flow indicators, like you're talking about. Those work for a reason. I could literally line up the 30 biggest or 20 biggest stock market adages and explain them all from a vantage point. And we should do that on one episode. Let's make a note. And explain them from the vantage point of an options market and the flows that come out. Seasonality. Can explain every single part of seasonality as a function of this, right?
Selling may go away.
Yeah, exactly. We can go through all of these different parts, right? And so the point I'm trying to make is those are essentially, if you don't understand what's happening in the hood, you notice trends, and people follow those trends and those things. And so those are the outward price kind of representation of what's going on in the hood. What I'm trying to teach people here is the why and the how, because it's one thing to have like 70%, 65% accuracy on, oh, this tends to happen and I'm going to take this bet. It's another thing to know when and why there's a high probability of that 65% happening or not, right? And understanding why and the scale and all the dynamics that are tied to it. And that's really what we're trying to do here. So let's do that here. Let's walk through the crystal ball a little bit and try and dive under the hood. Yeah.
I'm about to make some money.
So, yeah. So, we were very clear that we would get this counter trend move off the bottom. Now, it was a little bit deeper than we initially thought, but this is not, I want to preface this as we see 25 to 50% of the picture. And when I say 25 to 50%, at different times, the flows are more important than other times. And when they're really strong, like they are right now, it's much more valuable and predictive. But there's a lot of things that we cannot predict, right? Like if a nuclear bomb goes off in New York, guess what? The market will go down really big. I'm not trying to predict that, right?
Do you have any information we should know? We're actually going to New York this weekend.
Yeah. Better than Tel Aviv right now. I think you're probably okay in New York for now. But no, I think the reality is that if you have 25 to 50%, that also tells you, if you watch that 25 to 50% and you understand it very deeply, that tells you a lot about the other 50% you don't know, right? Because what's happening in the context of what you do know. When what you do know says X and that X doesn't happen, that tells you something about what's happening on the other side. So it's very powerful, not just in knowing what we know and how it works, but also telling us in real time about kind of what's happening to the other side of things and interpolating that. So we saw this rally back, and again, this is pretty typical for a topping process to revisit after an initial kind of vol kind of event, to widen vol out and get it to this more kind of 20% type level, to loosen markets, because again, as we were talking about, implied volatility when compresses the market itself. And so we're at a higher range than maybe we were last year or in other periods prior, which still allows for some movement. And that's as a function of the macro headwinds and the bigger issues that we had that have led to the initial decline. So, but what tends to happen is shorts are hard by definition. Why are they hard? Because at the end of the day, if entities who need to track the S&P are underweight or institutions are short, that means there's less supply, right, in markets. And it tends to be that retail and more kind of consistent longs and flows squeeze those institutions during some part before the final decline finally comes. And this is why you tend to see institutional shorts and retail longs, in the last part of the rally. Take a look. That's exactly what we're seeing now. Retail gets more confident. Nothing changes sentiment. And it's not just retail. I want to be clear. These are long-only institutions, but nothing changes confidence like an up market, right? And as sentiment finally turns, and the bigger macro picture does eventually come to play, right? That eventually overwhelms the alternative. And at first, that bigger structural decline starts more slowly, which is what I expect we will see. It tends to start with almost like this market down, vol down, because institutions are short, and so they represent less demand, less supply, for markets. They represent more demand into a decline. But eventually, after some initial decline and some profit taking, eventually the tail accelerates and usually ends with some big candle at the end. Bottoms are an event, tops are a process. Quite typical for a bigger decline to be met, and we do believe a bigger decline is coming, to be met with these constant retesting of the highs, maybe even minor new highs. I've lived and operated from the inside of the belly beast through multiple big declines. Right, the tech bubble was a big one. Take a look at the tech bubble. What happened? The Nasdaq peaked in January 2000, and in March the S&P peaked. So there were 3 months, and there was several attempts at a decline right before it finally played out. It really took almost like a 6-month topping process, really. There, 07, very similar, right, in its own way. And it's because the supply and demand imbalance. Another thing happens because it's so easy to sell calls over the market when you say, well, the market's not going there because valuation's already crazy and there's all this macro stuff going. You can create a bit of a squeeze at the end, right, where vol starts to go up a little bit at the end. And sometimes that blow off top is just enough, and that unpinning of supply from it getting too low is ultimately something that leads to a bigger decline. So we saw this rally coming. The question was, how far is it going to go? How long is it going to last? And our call has been, it may start as early as May. The bottom was, somewhere 57.5, up to 6,000, 6,100. Earlier in the year, it was 6,000 to 6,300. And, any of these things are possible throughout this process. But we have very much gotten to this point. Vol's been compressed. We're in the summer of George, and the macro headwinds have continued to. If you just look at what's happening under the hood, the news across every single liquidity picture, every single factor has gotten even worse. So we are now in a market where the market is being supported by these structural flows in the most supportive period. And like I said, when these flows act a certain way and you don't see the opposite, the market grind higher, that tells you something about the other flows. And so from a macro perspective, today, actually tomorrow morning, right, in the AM print represents the last puff of Vana charm flows, and the vol compression will continue for a bit, but the actual Vana charm flows are now done. And so if we were seeing kind of sideways action in the face of all of those flows, which by the way are historic. People point out that this June Opex was the biggest open interest of any Opex in history. Guess what? March was the biggest before that. Right? Because the amount of structured product issuance and all these things, as I said, are growing at such a scale that these things are more and more important, more dominant. Go look through the last 12 months of options expirations. Just go draw a line. There you can go find it on the internet, on Twitter. Go take a look. Every single one is some kind of an inflection point. That's not a coincidence. Okay. And so the point is we've gotten to the actual movement, price action is telling you a lot about of what's likely coming here. Now, that doesn't mean a crash. That doesn't mean this market is about to, that'll get the headlines and get everybody ramped up. But I want to be clear, we strongly believe that vol compression will continue for another month, at least, probably two. And that's from an implied vol perspective. And the implied vol has a reflexive effect on realized. But we feel strongly that ultimately, especially the next several weeks, market down, vol down is a very high probability outcome. And that increasingly that implied vol will outperform. Think of a 2022 environment where market dropped 27%, right, at its low, but the whole way it was massive vol compression. It was very kind of a slow-moving train wreck. And the reason was because people were very well hedged, vol was very well supplied throughout, right? And people were prepared for the decline. Didn't mean the decline didn't happen, by the way, right? So we feel strongly that is broadly what we're looking at. It will be a slow motion train wreck. We do think the range for the year is set, meaning we don't think we'll get below the lows, which, by the way, are now close to 20% below here, which is pretty wild to think just a couple months ago. I don't think we're returning there. I don't think we're returning there quickly. But would it? My base case, and we'll see, is in the next 6 months we return to those lows, and we do it in a kind of slow market down, vol down drip. And there will be a lot of realized volatility, an increasing amount of realized volatility as we move forward. So, it doesn't mean that realized volatility is going to happen now. But we do think that increasingly as you move forward, the vehicles to take advantage of these moves are going to be zero DTE type options, right, which are just pure gamma, pure convexity. We do think there'll be a lot of macro headlines and big kind of disjointed moves, but I think it's going to look more like a stair step, and that'll be reiterated, reemphasized by implied vol compression, which will continue to be persistent. Part of the reason we believe this is not just the current vol supply that we see, but historically, if you look through the last 10 years, it's almost like a sine curve in terms of how vol performs into a market decline. Why? Two reasons. One, everybody's fighting the last war. So, when people think about the decline coming, what's everybody's first thought? Oh, this is going to be volatile. I need to buy puts. Why? Because they just saw a massive performance of puts and vol. Like, they made so much money on it, and they're like, well, I'm going to do that again. And then guess what? People are prepared for it, and then it doesn't work. And then it doesn't work, and people are like, why the hell would I ever buy puts? Market
Knowledge
went
is
down.
vol dampening, baby.
Yeah, exactly. And so, again, I've walked through this other times, but August 15, big vol event, market decline. February 16, bigger decline, massive vol compression. February 18, volpocalypse. October, November, December, bigger decline, massive vol compression. And then fast forward COVID, massive vol event. 22, massive vol compression. Here we are, massive vol event. Okay, well, what's going to happen? So I said the first reason everybody's fighting the last war, but two, there's actually a structural reason. Because anybody who was long vol or had a long vol fund or was a long vol manager or did whatever just made a bunch of money convexly and just got a bunch of inflows. So guess what? A lot more people who are hedged now. And all the people who are short vol are out of business.
I need to go find those guys and rob them.
Right? So guess which one's going to work?
Answer.
No, the short vol is going to work. And then when the short vol makes a bunch of money and that everybody's piled into it, think XIV. Everybody was piled into XIV. Markets at the end of the day, we can talk about the Greeks and other thing. They are a voting machine. They're supply and demand. And when the supply and demand on the vol side changes, then that's the most likely probability. And so reflexively, people are broadly hedged for what's coming up from a vol perspective. Doesn't mean a decline's not going to happen. It means that vol is probably not going to work nearly as well when that does happen. And I think that's a really important thing to understand. It's not 100% accuracy, right? But I think that the probabilities point to that. That's the more probable outcome from here. And I will note, I kind of highlighted when I was saying it there, but understand that often, not always, often the declines were market down, vol down as a percentage basis, even though they're slower, end up being worse. Mm-hmm. And the reason is when puts don't hedge, institutions actually get more hurt because now their hedges aren't working. That's even more painful. And then as a secondary reason that we don't turn around as quickly is this vol and charm effect. If vol expands and you have a big vol event, well, that means that vol has to come down, which drives these von and charm flows back. But if you never get the vol expansion, really hard to bottom and get a V return. And that just forces kind of this slow, painful grind lower.
Jeez, man. Well, so RIP my SPX put spreads for September and August. So
just go sell them and buy some 0 DTE puts.
Yeah, because I do love gambling. I mean, baby, I like driving fast in the car. I love breaking laws, and I love gambling. That's how I became the best trader there is. But so as we go out, Jim, what the hell, man? You tweeted on June 1st about martial law plans being drawn up in the Oval Office, and you scared the crap out of Emil here.
Right? Like people are like, "Who that? Like, I got the number of is your account hacked questions."
You scared a lot of people.
Yeah, you scared us, dude.
A lot of
people.
His pants. You know, I consider you a pretty reasonable guy. A lot of people tweet a lot of things like, "Oh, I'm hearing all kinds of stuff," but I was like, "Oh my god!" I think we were together when it happened in Denver, and we were like, "What the hell?" And then I got home and I showed my girlfriend, and now she's scared.
Heard from a little birdie that the rough outline of plans for a manufactured crisis that would necessitate martial law are already being drawn in the Oval Office in 3 years or so. If this comes to pass, know that this was not a coincidence.
Yeah, I can't speak to the little birdie. That's something I can't do. But what I can tell you is that I would not tweet that if I did not have a reliable source. And I will also tell you that since I've tweeted that, we have had a lot of riots that are being suppressed.
A lot of trial runs, maybe.
And we now have Israel and Iran and the U.S. going to a war in the Middle East. So I'm not a conspiracy theorist, guys, but when we live in a world where people very much know, by the way, read Donald Trump's own tweets.
Yeah.
Years ago, he was very clear that if Obama, right, goes into Iran, you'll know why, because he's looking to get reelected. Those are his words, not mine. This is not I'm not saying something controversial. Separately, Trump is being very, very clear that he wants another term. He said that. Like, how many times does he have to say it?
Yeah, maybe they'll give it to him.
I mean, you just have to listen to him. Like you said, they're selling hats on his site that say Trump 2028. It's they're not.
So why am I? What I'm saying? Why is that so controversial?
It's not. It's just scary.
It's scary. Yeah. You know what else is scary? Israel bombing Iran and Iran over nuclear weapons. And the U.S. entering the fray to what is generally considered the most dangerous place in the world and the beginning of many, many world wars. Like, this is not... We are like the frog in the pot being boiled.
It feels so good right now. I mean, as a frog,
nice
this water
warm.
feels so good.
Yeah, I mean, it's like every day it's like, whoa, I thought this would be the end of the world. Now, this is like normal now. This is kind of nice. Like, this is
these
fine.
bubbles
I can
feel
live.
good.
Yeah. But that's a problem because...
But that's why it's scary. I think it all feels like, it's supposed to happen so slowly that we don't notice it. And then when...
But that's why I'm tweeting it, because I want everybody to notice.
Yeah.
Yeah.
Because everybody's just getting boiled.
Yeah, but have you ever considered that noticing feels bad sometimes for people like us?
Yes. It feels really bad, and that we need to feel bad. I've actually, I'll leave on this note. Without a crisis, we do not have, without clearing the underbrush, the whole thing will burn down, right? People are scared of fire. People don't want crisis. But you cannot remove crisis from the system. If you do, you get something worse, entropy. You get entropy. And what we're in the midst of is 40 years of entropy. And so if you want to unite people and to resurrect the blessings of liberty for ourselves and our posterity, unfortunately, a crisis is what we need. And so that's the positive, right? The real negative is if nothing comes of this and the frog just boils and we move on. Not a political comment. It's just the reality. Founding fathers created the United States and democracy and made it hard to pass laws because they didn't want absolute power to corrupt absolutely. They didn't want anybody to have the levers of power. But what that means is if you smooth the business cycle with something like the Federal Reserve, right, and you never have a crisis for 40 years, people move away from each other into their corners. There's never a crisis. There's never a passing of laws. There's a reason we haven't had a constitutional amendment. There's a reason we haven't, that no laws and stuff were being passed in any meaningful way and any changes were happening. But as we lead to greater crisis and greater disunity, right, we are starting to see movement and action. And that's a good thing. That's a good thing. But I'm here to tell you, if you think we're in crisis now, go tell the people in 1968, 1969, during race riots and assassinations and the Vietnam War and drafting, that this is a crisis. Go tell the greatest generation during World War II that we're in crisis. People have lost complete vision of what a crisis is. So it's coming. Prepare yourself. But it's good.
Which is a great time to thank our sponsor of today's episode, Lockheed Martin, and the Hellfire missile.
Yeah.
And the Patriot missile.
We need a
Without
prepper.
which
We need a
never
prep-
know freedom.
We need a prepper sponsor. Yeah, get your bunker right. But that's the reality. And so you have to think about longer time frames and think about the bigger picture while still thinking about options expirations and weekly moves and how those two things ultimately connect somewhere in between.
Yeah.
Yeah.
And on that note, why not call your mom this weekend?
Yeah.
Tell her that you love her.
Tell
Hug
her-
your children if you've got them.
Tell her that she doesn't actually know crisis, but she will know it. She will know it.
Yeah. Jim, you are an absolute joy. We love
Yeah.
talking to you. We look forward to talking to you again soon. And thank you very much. Make volatility
Yeah,
great
let's
again.
make
There
volatility
it is.
great
We
again.
went from low vol summer George back to volatility again. So
Yeah.
Yeah.
Check him if you follow Jim already, but if you don't, it's jam_croissant on just search Jam Croissant on Twitter. You'll find him. Kai
I'm looking forward to
Volatility.
doing many more of these guys. This is
Oh,
going
yeah.
to be a ton of fun. Every options expiration going forward. So
Yeah, I imagine it'll only get more interesting too. So
there's a
Stay
lot
tuned.
of layers of the onion for sure.
Yeah.
All right. Well, thank you very much, Jim. We'll see you next time.
Wonderful being here. Thanks for having me, guys.
All right.
bye,
See ya.
Jen.